Hello guys, welcome all of you to the stream today. We would like to have a stream telling about the information about how to do the job. It's going so fucking crazy.
Plot.
Hi, actually, the Federal Reserve have just announced to keep the interest rate unchanged as in line with the expectation from the market.
Its major rivals, including the euro, as an immediate reaction to the news, but remains within familiar levels. Majors are struggling for direction as investors assess the announcement.
Let's wait for the press conference later for the speech from Powell, and we will see what he's gonna do to help boost the economic condition in the next few years.
pandemic continues to cause tremendous human and economic hardship here in the United States and around the world. The most important response to this public health crisis has come from our healthcare workers, and we remain equities and treasuries unchanged. Dollar firm. The greenback is firmer, although the only relevant moves are against the euro and the CHF. Euro USD challenging daily low at around 1.1810. USD CHF pressure 0.9100.
Hi, saying hi to you. I see one online here today. I would like to take you out how to trading with the news. Today is very big day because Federal Reserve have us now the interest rate decision for the for what for the remaining period of the year. Also, we have some kind of projection from the Federal Reserve, and we see that some kind of shrinking of the economic condition for the next projection for 21, 22, and 23. Actually, the market has some, yeah, you can see that, and the gold has bounced up and then bounced back and break the level of 1960. But don't be so don't be so overreact with the goal at the moment, because we have something coming up. Is the press conference later. Bowell will be on the stage to answer some Q&A question from many sides, from senator, from reporter, and maybe he will disclose something new to the market, and the market will react to that. And for at the moment, you can see that the Federal Reserve keep the interest rate unchanged, and everybody know that. Everybody knows that Powell don't try to sacrifice a lot, as the same thing with the ECB.
Expect Mr. Held to be asked for clarification.
Yeah, the for what for the sorry, I'm kind of sleepy now, but I will try to have you have some view about the trading with the news with the Federal Reserve interest rate decision. Yeah, you can see on the screen that the FOMC press conference will happen in the next 1 hour, and we will see what will gonna be disclosed by Powell, because he's the one very very cautious on what he say, what the message he deliver to the market. So you can see that if you let the Powell say alone, you cannot get any information. But in the case that Powell get in the Q&A section, facing with question from many sides, he will disclose more things about that. That's the reason why the press. You can see here. See the goal here? The same, yeah. It's a huge range of 15 price, and if anyone are not familiar with trading with the news, this kind of fluctuation, this kind of blockchain is the the very unique gift of the trading with the new with some big day like this day, like today, talking about the Federal Reserve interest rate decision.
The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education
I will
program,
try
teachers
to
are
go with you, and we'll try to
college.
articulate with you something important from the Powell speech.
These resources
Hello mọi người, hôm nay thì chúng ta sẽ cùng nhau trade Go với buổi tin tức ngày hôm nay, với tâm điểm là buổi họp báo của Chủ tịch Fed Powell về những câu chuyện, những tầm nhìn của Powell sắp tới. Hy vọng thì chúng ta sẽ có được một khoảng thời gian khá là vui vẻ khi chúng ta cùng nhau trade và cùng nhau phân tích xem là thị trường sẽ phản ứng như thế nào với từng cái phát biểu của ông Powell trong cái buổi họp báo ngày hôm nay.
Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the board and reserve banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at FedEconEd. What is the Fed?
So what is the Fed?
What is the Fed?
What is the Fed? The Federal Reserve, often referred to as the Fed, is the
central bank of the United States.
Congress created the Fed in 1913 to help promote a safe and sound monetary and financial system for our nation. The Fed includes the Board of Governors in Washington, D.C., which has 7 members, including the chairman and vice chairman. All of the members of the board are appointed by the President of the United States and confirmed by the United States Senate. The Fed also includes 12 regional Federal Reserve banks located in cities throughout the country.
The reserve banks serve as the central bank's operating arms and also gather economic information from all over the country to help the Fed both monitor the economy and get the broad input necessary to develop
equities gain.
Effective
Dow
US
plus
monetary
285 S&P.
Today, the
P
Fed
plus
performs a
22.
number of important functions, all with the ultimate goal of promoting a healthy U.S. economy. One of the Fed's most recognizable functions is conducting U.S. monetary policy, which involves influencing interest rates and the availability of money and credit in our economy. Congress has tasked the Fed with implementing monetary policies that promote maximum employment and stable prices. High levels of employment provide people with more economic opportunities, and stable prices promote growth
by making it easier for households and businesses to plan for the future.
Monetary policy decisions of the Fed are made by the Federal Open Market Committee,
which includes all 7 members of the Board of Governors and presidents from the reserve banks. This committee meets regularly to assess the conditions and outlook for the economy. In addition to conducting monetary policy, the Federal Reserve also helps to supervise and regulate the nation's banks and works to promote a stable financial system for consumers, communities, and businesses. The Fed also works with communities, nonprofit organizations, and others across the nation to address housing problems, promote equal access to credit, and advance economic and community development. The Fed also promotes stability in the financial system, because instability in the financial system can pose a severe threat to the broader economy and communities across the nation.
The Fed also acts as a bank to other banks by clearing checks, making electronic payments, and providing the currency that Americans need to use every day.
Our nation's economy and financial system face constant challenges.
The Fed is working every day to address those challenges and is committed to helping foster good economic conditions and outcomes. Employment opportunities, stable prices, and financial stability that benefit all Americans.
And we are also the Fed.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
chairman. Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we have taken forceful actions to provide some relief and stability, to ensure that the recovery will be as strong as possible.
Major pairs have returned to pre-announcement
Today,
levels
my
as
colleagues
Powell
on the
starts
Federal
his speech.
Open Market
Here you
Committee and
go.
I made some important changes to our policy statement, including an update to our guidance for the likely path of our policy interest rate. Guided by our new statement on longer-run goals and monetary policy strategy that we announced a few weeks ago, these changes clarify our strong commitment over a longer time horizon. Before describing today's policy actions, let me briefly review recent economic developments. Economic activity has picked up from its depressed second quarter level, when much of the economy was shut down to stem the spread of the virus. With the reopening of many businesses and factories and fewer people withdrawing from social interactions, household spending looks to have recovered about 3/4 of its earlier decline. Nonetheless, spending on services that typically require people to gather closely, including travel and hospitality, is still quite weak. The recovery in household spending also likely owes to federal stimulus payments and expanded unemployment benefits, which provided substantial and timely support to household incomes. Activity in the housing sector has returned to its level at the beginning of the year, and we are starting to see signs of an improvement in business investment. The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up since our June summary of economic projections. Even so, overall activity remains well below its level before the pandemic, and the path ahead remains highly uncertain.
Powell's words. Economic activity
In the labor
picked
market,
up,
roughly half
Powell.
of the 22 million
Services
jobs that
still
were
quite
lost
weak.
in March and
Signs of
April
improvement
have
in
been
business
regained
investment.
as many people return to work. The unemployment rate declined over the past 4 months, but remains elevated at 8.4% as of August. Although we welcome this progress, we will not lose sight of the millions of Americans who remain out of work. Looking ahead, FOMC participants project the unemployment rate to continue to decline. The median projection is 7.6% at the end of this year, 5.5% next year, and 4% by 2023. The economic downturn has not fallen
About
equally
half of the
on all
lost
Americans,
jobs have been
and
recovered.
those least able to shoulder the burden have been hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers in the services sector, for women, and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. For some goods, including food, supply constraints have led to notably higher prices, adding to the burden for those struggling with lost income. More broadly, however, weaker demand, especially in sectors that have been most affected by the pandemic, has held down consumer prices. And overall, inflation is running well below our 2% longer-run objective. The median inflation projection from FOMC participants rises from 1.2% this year to 1.7% next year, and reaches 2% in 2023. As the economy began its recovery, COVID-19 cases, hospitalizations, and deaths also rose. The reimposition of some social distancing restrictions, as well as more cautious behavior by many individuals, have succeeded in slowing the spread of the virus. As we have emphasized throughout the pandemic, the outlook for the economy is extraordinarily uncertain and will depend in large part on our success in keeping the virus in check. All of us have a role to play in our nation's response to the pandemic. Following the advice of public health professionals to keep appropriate social distances and to wear masks in public will help get the economy back to full strength. A full economic recovery is unlikely until people are confident that it is safe to re-engage in a broad range of activities. The path forward will also depend on the policy actions taken across all parts of the government to provide relief and to support the recovery for as long as needed. The Federal Reserve's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We remain committed to using our full range of tools to support the economy in this challenging time. The changes we made in today's policy statement reflect our strategy to achieve our dual mandate goals by seeking to eliminate shortfalls from maximum employment and achieve inflation that averages 2% over time, as we articulated in our statement on longer-run goals and monetary policy strategy. We view maximum employment as a broad-based and inclusive goal and do not see a high level of employment as posing a policy concern unless accompanied by signs of unwanted increases in inflation or the emergence of other risks that could impede the attainment of our goals. And we believe that achieving inflation that averages 2% over time helps ensure that longer-term inflation expectations remain well anchored at our longer-run 2% objective. In turn, well-anchored inflation expectations enhance our ability to meet both our employment and inflation objectives, particularly in the new normal, in which interest rates are closer to their effective lower bound, even in good times. Hence, as we say in our statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these outcomes, including maximum employment, are achieved. With regard to interest rates, we now indicate that we expect it will be appropriate
to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment,
a few minutes to
and
refer to the
inflation has risen
employment
to
situation,
2%
repeat
and
what
is
he
on
said
track
in
to
the
moderately
previous month
exceed
about the
2% for
pandemic
some
hitting
time.
those with the lower income
In
and the
addition,
Fed providing
over
support.
coming months,
Not
we will
much
continue
new
to
there.
increase our holdings of Treasury securities and agency mortgage-backed securities, at least at the current pace. These asset purchases are intended to sustain smooth market functioning and help foster accommodative financial conditions, thereby supporting the flow of credit to households and businesses. We believe the strong policy guidance we are providing today will serve the economy well by promoting our goals through the many possible paths the recovery may take. Of course, as we note in our policy statement, we would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of our goals. The Federal Reserve has also been taking broad and forceful actions to more directly support the flow of credit in the economy for households, for businesses large and small, and for state and local governments. Preserving the flow of credit is essential for mitigating the damage to the economy and promoting a robust recovery. Many of our programs rely on emergency lending powers that require the support of the Treasury Department and are
We
available
expect to
only
maintain the
in
current
very
Fed
unusual
fund rate until
circumstances,
our employment
such as
and
those we
price
find
stability
ourselves in
mandates are
today.
met. Standard Fed
These
rhetoric.
programs serve as a backstop to key credit markets and appear to have restored the flow of credit from private lenders through normal channels. We have deployed these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. When the time comes, after the crisis has passed, we will put these emergency tools back in the toolbox. As I've emphasized before, these are lending powers, not spending powers. The Fed cannot grant money to particular beneficiaries. We can only create programs or facilities with broad-based eligibility to make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers are benefiting from these programs, as is the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend and to make decisions about where we, as a society, should direct our collective resources. The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. Even so, the current economic downturn is the most severe in our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year, and it may take continued support from both monetary and fiscal policy to achieve that. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Finally, I would like to take a moment to recognize the passing of our friend and colleague, Thomas Laubach. His outstanding analysis and advice have been indispensable to the FOMC and have played a key role in the policy decisions that will define this era of the Federal Reserve.
Dollar under uneven
He will
pressure.
be remembered
The dollar
for his
is under
intellect, but
pressure,
also for
although the
his
market
kindness,
still misses
his
fireworks.
equanimity, and his dedication to achieving our
USDCAD the
mission on
most
behalf
active, as the
of the
loonie is
American
being
people.
underpinned by soaring oil
We will miss him.
prices.
Thank you. I'll now be glad to take your questions.
Thank you, Nick Timorous.
Good afternoon, Chair Powell. Nick Timorous from the Wall Street Journal. You've been very clear about the committee's intentions on rates, not even thinking about raising rates, and today showing low rates even as unemployment falls to 4% and inflation rises to 2%. My question is about asset purchases. Does the guidance today apply to the current asset purchase pace? Are there any macroeconomic conditions under which you would favor increasing the monthly pace of Treasury and MBS purchases? And under what conditions would a decrease in the monthly pace of purchases be appropriate? Thank you.
Thank you. So we say in our post-meeting statement that we'll continue to increase our securities holdings at least at the current pace over coming months to sustain smooth market functioning and help foster accommodative financial conditions. That latter part is an updating of our guidance to reflect what I've been saying in these press conferences for some time, and what other central banks have acknowledged, which is that the purchases are fostering accommodative financial conditions as well. That amounts to roughly 80 billion a month of treasuries and 40 billion net per month for MBS. So we do think that these purchases have been effective in restoring orderly market conditions and have supported the flow of credit to households and businesses, including by fostering more accommodative financial conditions, which of course we think is a good thing. So in terms of going forward, I would just say this: there are various ways and margins that we can adjust our tools going forward, and we'll continue to monitor developments, and we're prepared to adjust our plans as appropriate.
If I could follow up, I suppose the question I have is, why give guidance on one policy tool but not give guidance on the other policy tool when the Fed has talked about those two policy tools working together?
So we think our policy stance is appropriate today, and we're prepared to adjust it going forward as we see appropriate. And today we believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today, will provide strong support for the economy. Effectively, we're saying that rates will remain highly accommodative until the economy is far along in its recovery. And that should be a very powerful statement in supporting economic activity.
Equities continue
now,
to gain.
We're buying
Dow plus
120 billion in securities per month
plus 2.6
across the Treasury curve. That's also adding to accommodation. We do have the flexibility to adjust that tool and the rate tool and other tools as well. But as for right now, we think that our policy setting is appropriate to support the expansion. We said from the beginning that we would first try to provide some support and stability and relief in the first phase of the crisis, the acute phase, and then we would support the expansion when it came. Well, it's here, and it's well along, and so that's why we changed our guidance today, and we do have the flexibility to do more when we think it's appropriate.
Thank you.
Thank you, Gina.
Hi, Chair. Thank you for your questions. Gina Smith with New York Times. I was wondering that you beefed up your language on financial stability in the long-run statement that you unveiled with your Jackson Hole speech last month. I'm wondering if you could kind of walk us through how you think about financial stability concerns as a factor in guiding future rate increases. Would financial stability concerns on their own be enough to merit changes in the Fed funds rate, or would they have to come in conjunction with an overheating on inflation or some sort of dramatic drop in the unemployment rate? If you could just sort of give us an outline of your thinking there, please.
So what we said in our
we are effectively saying that rates will remain highly accommodative until the economy is well on the way to recovery.
The committee's policy decisions reflect its longer-run goals, its medium-term outlook, and its assessment of the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. So that's what we said about financial stability. And today we said that we'd be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of our goals. But you asked specifically about financial stability. One thing I would say is that monetary policy should not be the first line of defense. It is not the first line of defense on financial stability. We look to more appropriate tools in the first instance as a first line of defense, and those would be regulation, supervision, high capital, high liquidity, stress testing, all of those things, macroprudential tools, all of those things are really the first line of defense on financial stability. But we always leave open the idea that we will not ignore those kinds of risks and other kinds of risks more broadly that could impede the attainment of our goals in setting monetary policy. So that's really how we think about it. But principally that other tools are the front line, as I mentioned.
But just to follow up quickly, if other tools aren't forthcoming, would financial stability concerns in and of themselves be enough to warrant a rate hike?
So it's what we said in the longer run in our consensus statement is that we policy decisions reflect the balance of risks, including risks to the financial system that could impede the attainment of the committee's goals. So the test would be, does a majority of the committee feel that that monetary policy is triggering that, and that would be the test. And it's not something that we've done. We do monitor financial stability concerns, of course, intensely and regularly. We try to use our other tools on them, but we do keep them in mind as we think about monetary policy.
Thank you. Steve Fleeceman.
Mr. Chairman, I wonder if you could help me understand how the projections of the committee line up with the goals of the committee. You've now altered the projections to the statement to aim for inflation above 2%. But when I look at the SCP, I don't see the committee believe a single year in the next 4 years that you are ever above 2%. In fact, for each year, you were below it until 2023 was the first time that you actually hit 2%. So do you think, are you confident? Is this just the committee is not confident that not only can it not hit its 2% goal, but that now it can't hit its goal of being above 2%?
Not at all. You also don't see people, by and large, lifting off or raising interest rates above zero. I guess there are 4 exceptions out of a committee of 17 during the forecast period. So we don't reach 2%, but we get very close to it in the forecast. And we reach 2%. I guess the median is 2% at the end of 2023. So what the guidance says. It says that we expect that the current setting of our rates will be appropriate until such time as we reach 2% inflation, that we feel that labor market conditions are consistent with our assessment of maximum employment, and that we're on track to achieve moderate inflation moderately above. So that's the test. So I don't think there's any conflict between those two, because the way they're set up, the projections don't show the out years. You ask about confidence, and I would say that this very strong, very powerful guidance shows both our confidence and our determination. It shows our confidence that we can reach this goal and our determination to do so.
I'm sorry if I'm just without being simplistic about this, but why wouldn't, if the committee was confident that it could reach its new goal of aiming for inflation above 2%, why wouldn't one of those years at least show inflation being above 2% on the median forecast?
Because we think, looking at everything we know about inflation dynamics in the United States and around the world over recent decades, we expect it will take some time. We expect that the economy will recover quickly now, but that pace will slow as people go back to work, and we'll still have an area of the economy, a big area of the economy that struggles. There'll be slack in the economy. The economy will be below maximum employment, below full demand, and that will tend to put downward pressure on inflation. So we think that once we get up closer to maximum employment, we think that inflation will come back generally. And that's sort of what happened during the last long expansion. It's a slow process, but there is a process there. Inflation does move up over time. We do expect that will continue today, and we expect that our guidance is powerful and will help that outcome. We think that effectively saying that policy will remain highly accommodative until the economy is very far along in its recovery should provide strong support for the economy and get us there sooner rather than later.
Thank you.
Thank you. Rachel Siegel.
Hi, Chair Powell. Thanks very much for taking my question. I wanted to ask if you anticipate a slowing in the pace of the recovery if there is not another stimulus package, and specifically if there are particular holes still remaining in the economy that you think could be helped by more aid from Congress. Thanks very much.
Sure. So first, if you look at the summary of economic projections that my colleagues and I filed for this meeting, what you'll see is an expectation that the recovery will continue, that it will continue at a reasonable pace through 2021, 22, and 23. We do expect that pace will slow, just because you would expect that the pace would be fastest right at the beginning of the recovery, because you had such a sharp decline. You would expect that the third quarter should be the fastest gains, and then after that, the pace should slow down to a more normal pace. So we do expect that. In terms of fiscal policy, you asked about fiscal policy. So, one thing, I guess I would start by saying that the initial response from fiscal authorities was rapid, it was forceful, and pretty effective. And we're seeing the results of that today in the income and household spending data, in the labor market data, in construction data, in the data for business equipment spending, and the fact that businesses are staying in business, and the pace of defaults and things like that has really slowed. So there's been a really positive effect. That said, my sense is that more fiscal support is likely to be needed. Of course, the details of that are for Congress, not for the Fed. But I would just say there are still roughly 11 million people still out of work due to the pandemic, and a good part of those people were working in industries that are likely to struggle. Those people may need additional support as they try to find their way and through what will be a difficult time for them. We've also got struggling small businesses, especially those in the business of facing directly to the public. And we have state and local governments dealing with a drop in revenue. At the same time, spending has gone up, much of it related to the pandemic and economic effects. So again, I would say the fiscal support has been essential in the good progress we see now. And finally, I'll note that just about all, the overwhelming majority of private forecasters who project an ongoing recovery are assuming there will be a substantial additional fiscal support.
Thank you. Mike Derby.
Taking a question. Should we expect any further evolutions in forward guidance, say maybe an adoption of something akin to the Evans rule that we had a few years ago, or is there something else that the Fed might be considering in the future?
Well, so we think that the forward guidance we adopted today is appropriate and, as I mentioned, powerful. Effectively, what it says is that we will keep policy where it is now, keep the rate policy where it is now until unemployment reaches
accelerates its slump,
the committee's
challenges the
assessments or levels that are not unemployment. Labor market conditions
against most
reach levels that are consistent with the committee's assessments of maximum employment until inflation reaches 2% and until it's on track to go above 2%.
There's no reason for the dollar to
moderately for some time. So that's very strong forward guidance, and we think that that will be durable guidance that will provide significant support to the economy in the coming years. So that's really our thinking on forward guidance on rates.
Thank you. Howard Schneider.
Thanks, Chair Bell, for doing this. Sort of follow up on Mike's question there. Since you described this guidance as durable, you've set up a three-part test here for rate hikes. Levels consistent with assessments of maximum employment. Inflation has risen to 2%, and you're on track to moderately exceed 2% for some time. Each of these have modifiers, and I wonder if you could explain a little bit more. How do we pin down assessments of maximum employment? When you say that inflation has risen to 2%, does that mean 2% for a day, month, 6 months? And when you say on track to moderately exceed, how should we define moderately, and how should we define for some time?
So, as you know, maximum employment is not something that can be reduced to a number the way inflation can. It's a broad range of factors. It really always has been, and really substantial number of factors that we've indicated we would look at. So it's broader labor conditions consistent with our committee's assessment of maximum employment. So that would certainly mean low unemployment. It would mean high labor force participation. It would mean wages. It would be a whole range of things. And we're not looking at a rule. We're looking at a judgmental assessment, which I think we'll be very transparent about as we go forward. In terms of inflation, this is a committee that is both confident and committed to and determined to reach our goals. And the idea that we would look for the quickest way out it's just not who we are. It's not that there's no message of that here. We would not be looking for 1 month of 2% inflation. We said return to achieve 2% inflation. Okay, so just understand that we're strongly committed to achieving our goals and the overshoot. So that should tell you about that. In terms of, so what does moderate means? It means not large. It means not very high above 2%. It means moderate.
Congress.
I think that's a
Powell's
fairly well
comment of
understood
more
word.
fiscal support
In terms of for a time, what it means is not permanently.
Is the
and
Fed
not for a
saying it is
sustained
done for
period.
now?
You know, we're resisting the urge to try to create some sort of a rule or a formula here, and I think the public will understand pretty well what we want. It's actually pretty straightforward. We want to achieve inflation that averages 2% over time, and if we do that, inflation expectations will be right at 2%, and that'll help us achieve 2% inflation over time and avoid the situation where the central bank loses its ability to support the economy.
Thank you. James Politi.
Thanks for taking the question. James Politi with the Financial Times. Do you consider today's enhanced full guidance to actual accommodation to the US economy from a monetary perspective, and sort of deliver further support?
The Fed's average inflation does not appear in its own projections at the end of 2023.
And in terms of fiscal support, do you assume in your own projections, not just the private forecasters, that additional fiscal support will be forthcoming, or do you expect a weaker growth or a larger contraction rather this year if no fiscal support is forthcoming?
So in terms of the effects, so I think what we've done is more or less aligned with the consensus statement today. So it's in line with what might have been expected. As I mentioned, I think over time it will provide very powerful support for this economy as we move forward. In a sense, it's consistent with expectations. So I'm not looking for a big reaction right now, but I think over time, again, guidance that we expect to retain the current stance until the economy has moved very far toward our goals is a strong and powerful thing. And I think that will be supportive of the economy over time. In terms of additional fiscal support, I guess your question is what would happen if, people have different assessments, and different participants in the FOMC made different assessments on their own. I think broadly, though, there is an expectation among private forecasters and among FOMC participants that there will be some further fiscal action. And there does seem to be an appetite on the part of all the relevant players to doing something. The question is how much and when. And so I would just say that if, and it's very hard to say, so far the economy has proven resilient to the
latest update on forward guidance was powerful and strong, no more changes ahead.
But
however,
there's certainly a risk,
reaffirmed that the central bank is ready to act as needed, taking action to the pandemic developments and, of course, the employment situation.
And they'll now spend them, and that as the months pass, if there's no follow-up on that, if there isn't additional support, and there isn't a job for some of those people who are from industries where it's going to be very hard to find new work, then that will start to show up in economic activity. It'll also show up in things like evictions and foreclosures and things that will scar and damage the economy. So that's a downside risk. So I think the real question is when and how much and what will be the contents. No one has any certainty around that, but broadly speaking, if we don't get that, then there would certainly be downside risks certainly through the channel I mentioned.
Thank you. Anakin, CNN. Thanks for taking my question.
There is an expectation among private forecasters and the Fed members that there will be further
stimulus. Is the Fed
stimulus.
open to other measures of the economy, such as income inequality and affordability of housing?
So we monitor everything we think is important in the U.S. economy, and in broad sense, all of it goes into thinking about monetary policy. You mentioned inequality, so disparities in income and in financial well-being by various demographic and racial categories, something we monitor carefully. Inequality, which I would point to, it's a multifaceted thing, but I would point to the relative stagnation of incomes for people at the lower end of the income spectrum and also lower mobility. So those are things that hold back our economy. They are. The thing is, we don't really have the tools to address those. We have interest rates and bank supervision and financial stability policy and things like that, but we can't get at those things through our tools. When we lower the federal funds rate, that supports the economy across a broad range of people and activities, but we don't have the ability to target particular groups. Notwithstanding that, we do talk about it because these are important features of our economy, and I think those distributional issues are issues that are really for our elected officials. And I would say I take them seriously as holding back our economy. The productive capacity of the economy is limited when not everyone has the opportunity, has the educational background, and the health care and all the things that you need to be an active participant in our workforce. So I think we can, if we want to have the highest potential output and the best output for our economy, we need that prosperity to be very broadly spread in the longer run. And I would just say the Fed, we can talk about those things a lot. And when we think about maximum employment in particular, we do look at individual groups. So the high unemployment in a particular racial group like African Americans, when we would look at that as we think about whether we're really at maximum employment. We would look at that along with a lot of other data. So the answer is we do look at all those things and do what we can with our tools, but ultimately these are issues for elected representatives.
Thank you. Edward Lawrence.
Yeah, thank you, Chairman Powell, for the question. I just wanted some clarity here. At what point do you think it's prudent to shift the bond purchases from the market stability, as you had said, from the shorter term maturities to more longer term, more stimulus related?
So we think that our asset purchases are doing both those things today. We think clearly there's been great progress in terms of market function. If you remember early in the spring when the acute phase of the pandemic hit, market function was very low, and it's improved rapidly and in many respects is in a good place now. We also, though, think that these asset purchases, which total 120 billion a month, which is much larger than for example, the last asset purchase program during the global financial crisis and the recovery therefrom. We think that that's also providing accommodative financial conditions and supporting growth, and we think that's fine. We're also aware that there are ways we can adjust that, to do various things, make it smaller, make it larger, and also target different sectors of the curve. And we're going to continue to monitor developments, and we're prepared to adjust our plans as appropriate.
Thank you, Victoria. Victoria Guida. Hi, thanks for taking my question. I wanted to ask about a couple of things. First of all, if we don't get a vaccine until well into next year, what does that mean for the economy? And then somewhat related, I was wondering if you could provide any more detail about the stress scenarios that you all are going to release for the big banks and whether that is going to be another full-blown stress test, whether we're going to publicly see those results and what it might mean for bank payouts.
Great. So on the first one, what's happening is basically we're learning to live with, right now, we're learning to live with COVID, which still spreads. And we're learning to engage in economic activity. All of this recovery that we've seen is in a context where, where people are still at risk of catching it. And yet we're able to resume lots and lots of economic activities. And that involves, as I mentioned, I think the more social distancing we can preserve as we go back into the workforce, wearing masks, keeping our distance, that kind of thing, the better we'll be able to get economic activity back up close to where it was. I do think, though, there are areas of the economy that are just going to really struggle until we have a vaccine that's in wide usage and is widely trusted. And those are the ones where people are getting really close together. I also think more fiscal support is likely to be needed. Cheap and rapid testing you can do a lot with that in the workforce. You can build confidence in the workforce if you have very regular testing. It doesn't cost very much, and you get the results really quickly. If you do that, you'll be able to open a lot of workforces, particularly in cities where the overall case numbers are quite low, and that will help a lot. So I think we're going to be finding lots and lots of ways to get out towards, as far as we can. There's always going to be that for some time. There's going to be certain activities that will be hard to resume. So I think that's the only way I can say it. And I think trying to, when we make a forecast, we make assessments about that, but it's really hard to say. There's no template here. There's no, there's no experience with this. So frankly, for the last 60 days or so, the economy's recovered faster than expected. And that may continue or not. We just don't know. And I think we should do those things that we control to make sure that we can recover as quickly as possible. And the main thing, again, is wearing a mask and keeping your distance while you're in the workforce. That's something we can all do that will limit the spread and let people go back to work, avoid major outbreaks and things like that. In terms of the stress test, so I really don't have any, we're getting ready quite soon to be making announcements and saying things publicly. There's not much I can say with you. Nothing really that I can say that's on that today. I don't have anything for you.
Thank you. Correspondent.
Thank you, Michelle. Good afternoon, Chairman Powell. You have emphasized many times, including today, that the Fed can only lend and not spend, and sometimes the latter is what's really needed. But to the extent that a $600 billion lending program for small and mid-sized companies could help,
one encouraging comment.
Exactly
the last 60 days, the economy recovered faster than expected. Powell said.
The Main Street
Still,
lending
he
program,
added they don't know if this situation will continue.
$1.4 billion in loans so far. Eric Rosengren of the Boston Fed was recently that Congress should clarify how much risk it wants the program to take. But Congress has already appropriated substantial funds for the 13.3 programs, and these are funds that are explicitly designed to absorb losses. Meanwhile, my colleagues who cover the banking sector say they're being told by commercial banks that the Treasury Department is advising them to target zero losses in Main Street program loans. So, if I may, why is it that the Federal Reserve, the Congress, and the Treasury apparently cannot agree on a loss tolerance that should be applied to the Main Street lending program in a way that would allow badly needed credit to reach these companies? Thank you.
Sure, sir. So a couple things about Main Street. It reaches the whole nation. It's got more than half of the banking industry assets signed up among the banks that are part of it. And it's making loans. The number's more like, it's close to $2 billion now. So the numbers are going up. Banks are joining, borrowers are coming. And it's significant. It's relatively small now, but it can scale up in response to economic conditions, should that be appropriate. If you look out in the lending world, surveys generally find that firms are not citing credit constraints as a top problem, and that is a lot of PPP, bank credit lines, and syndicated loans. There's a lot of credit being let out there. But you're right. We are looking at some things. We're looking at some lenders are concerned about the underwriting expectations. So banks are going to, their approach is likely to be that they're going to underwrite this loan roughly the same as they underwrite any loan. They're keeping part of it. And what we want to do is make sure that that they know that they should take the payment deferrals and other things in place, and also that it's really a facility for companies or borrowers that don't have access to regular way borrowing now. Otherwise, why would we need Main Street? So that's what we're working on, and we'll be doing we'll be making some changes in that respect. I saw what President Rosengren said. I can't really comment directly on that. I just would say
Meanwhile, there's little going on
that,
in the FX
you know,
world
this is
beyond
13.3.
EUR's weakness.
If you look at the law,
Commodity-linked
Section 13.3,
currencies are also
it's very
down
clear
near their opening
that we are
levels.
to make loans only to solvent borrowers, and the CARES Act is quite specific in keeping all of the terms of Section 13.3 in effect, including the requirement that we, you know, gather good evidence that the borrower is solvent. This law was amended in, you know, under in Dodd-Frank, and the idea was to make it challenging and put hurdles in place before we made loans. What at the time the thinking was to banks. So now we're using that same law for smaller business borrowers, and it doesn't. It's not
to avoid
a perfect
making the
fit.
longer run categories
I would
seem
also
like
just
lower
say
rates
for
forever.
many borrowers, they're in a situation where their business is still relatively shut down, and they won't be able to service a loan, and so they may need more fiscal support. Having said that, we're continuing to work to improve Main Street, to make it more broadly available, make it available pretty much to any company that needs it and that can service a loan.
Could you just very briefly address the reports that the Treasury is advising banks to target zero losses? Is that appropriate?
I can't say. I don't know about that. I haven't heard those reports. You know, again, if you think about it, we're going to have to go through the banking system to do this. We're not going to have 100,000 or 1 million loan officers working for the Fed and the Treasury. So we're going to go through the banking system, and the banks like to make good loans. That's what they do. They're trained to make good loans. So you should expect that we expect that they will do some underwriting. We also want them to take some risk, obviously, because that was the point of it. And the question is, how do you dial that in? It's not an easy thing to do. And you know, we're getting some loans made, and we're hopeful that we'll clarify this, and that credit will continue to flow.
Thank you. Chris, from Rayburn.
Hi, thanks for taking my question. Chair Powell, you've talked a couple of times about parts of the economy that may not recover as fast as we've seen so far. Presumably, you're referring to, you know, airlines, hotels, other sections, you know, parts of the economy that rely on close contact. How are you thinking about that in terms of its overall impact? Is that sector large enough to, say, keep unemployment above, you know, far above your maximum goals? Are you expecting that to come back with the vaccine, or are a lot of those folks going to have to find, you know, new jobs and new industries? And should we expect the Fed will keep rates at zero until all of that reallocation is done?
Yeah, of course we can't be really sure we know the answers to those questions, but I would say the likely path is that the expansion will continue, and it's, as I said, it's well along, and it'll move most easily through the parts of the economy. It'll still take some time, but the parts of the economy that weren't exactly directly affected, that didn't involve getting people in large groups together to feed them, to fly them around, to put them in hotels, do entertainment, things like that. Those are going to be the places that are very challenging. So there will also be the places that are affected that way, and that's going to be challenging for some time. It just is, and we don't really know how long that will be. It's millions of people. As I mentioned, we had 11 million, something like 11 million people in the payroll survey have gone back to work out of 22 million who lost their jobs in March and April. So that's half of them. So 11 million, particularly if the pace of returning to work slows down, it's going to leave a large group of people, and it'll be very meaningful from a macroeconomic standpoint. And our commitment is not to forget those people. As I mentioned, we want, you know, the sense of our forward guidance is that policy will remain, as we've said, highly accommodated until the expansion is well along, really very close to our goals. And even after, if we do lift off, we will keep policy accommodative until we actually have a moderate overshoot of inflation for some time. So those are powerful commitments that we think will support the full recovery, including those people, as long as it takes.
Thank you. Mike McKee?
Mr. Chairman, Michael McKee from Bloomberg Radio and Television. Based on what you were just saying about keeping policy accommodated for a very long time into the recovery, lower for longer, as far out as 3 years in your latest projections, is that basically it for the Fed? In other words, since interest rates are your main tool, the things you can do would push down on interest rates. But is it the case now that the only additional stimulus that can come to the economy is from the fiscal side?
Well, no, I wouldn't. I certainly would not say that we're out of ammo. Not at all. So, first of all, we do have lots of tools. We've got the lending tools, we've got the balance sheet, and we've got further forward guidance. So there's still plenty more that we can do. We do think that our rate policy stance is an appropriate one to support the economy. We think it's powerful, and as I mentioned, this is the kind of guidance that will provide support for the economy over time. The idea being that policy will remain highly accommodative until the recovery is well along, really very close to our goals, and then will remain accommodative even after we lift off. So I think that's a really strong place for rate policy to be. But again, we have the other margins that we can still use. So no, certainly we're not out of ammo.
If I could follow up, in terms of the balance sheet, are you concerned that your actions are more likely to produce asset price inflation than goods and services inflation? In other words, are you risking a bubble on Wall Street?
So of course we monitor financial conditions very carefully. These are not new questions. These were questions that were very much in the air a decade ago and more when the Fed first started doing QE. And I would say if you look at the long experience of the 10-year, 8-month expansion, the longest in our recorded history, it included an awful lot of quantitative easing and low rates for 7 years. And I would say it was notable for the lack of the emergence of some sort of a financial bubble, a housing bubble, or some kind of a bubble, the popping of which could threaten the expansion. That didn't happen. And frankly, it hasn't really happened around the world since then. That doesn't mean that it won't happen, and so of course it's something that we monitor carefully. After the financial crisis, we started a whole division of the Fed to focus on financial stability. We look at it for every perspective. The FOMC gets briefed on a quarterly basis. At the board here, we talk about it more or less on an ongoing basis. So it is something we monitor, but I don't know that the connection between asset purchases and financial stability is particularly tight.
I would not say we are out of ammo.
So
we have lending, the balance sheet, and forward guidance.
We won't be.
There is still plenty more we won't be. We do think
just
our
assuming
rate stance
we'll
will
be
provide
checking
powerful help to the economy
as we go. And by the way, the kinds of tools that we would use to address those sorts of things are not really monetary policy. It would be more tools that strengthen the financial system.
Thank you. Don Lee.
Chair Powell, I'd like to ask you about the labor market. As you know, in August, there were about 30 million persons claiming unemployment benefits. Yet, the BLS jobs report for August showed about 13.5 million unemployed, only about 6 million more than before the pandemic. I wonder how you reconcile that and what you think the actual labor market conditions are.
So, I think the overall picture, take a step back from this, the overall picture is clear, and that is that the labor market has been recovering, but that it's a long way from maximum employment. I think that's the bottom line on it. So within that, though, take claims in particular, the number of claims, the quantity of claims, and frankly, the fact that PUA claims are new, the pandemic unemployment assistance claims, that's a new system that had to be set up. The actual counting of the claims is volatile, and it's very difficult to take much signal about the particular level. So, because people were setting those systems up, and when they got them set up, they counted them all at once and things like that. I think, though, what you've seen is that the level of, certainly the level of initial claims has has declined very sharply from the very high levels of March and April, and is now at a lower level.
The S&P
continues either to be flat or
struggling
gradually
around
decline.
3,400
It's
on
worth
Powell's
noting,
message.
that's good. It's worth noting that that level is maybe 5 times the level of what claims were. Claims were around 200,000. Now they're 900,000 in that range weekly for initial claims. So that just tells you the labor market has improved, but it's a long way from maximum employment, and it will be some time getting back there. I think that's the best way to think about it. In many parts of the economy, there's just a lot of disruption, and it's really hard to say precisely where we are. I'll give you another example. With we say unemployment's 8.4%, but if you count those who are misidentified as employed when they're actually unemployed, and you add back some part of the participation number. So if you had a job and you were in the labor force in February and you lost it because of the pandemic, some of you are now being reported as out of the labor force. But I would more look at those people as unemployed. If you add those back, the level of unemployment is probably 3% higher. On the other hand, by that metric, the unemployment rate would have been in the 20s in April. So the improvement has been quite substantial under any measurement, but the level is still quite high.
Well, if I could follow up, is it the Fed's aim to get back to 3.5% or even lower?
Yes, absolutely. I can't be precise about a particular number, but let me just say there was a lot to like about 3.5% unemployment. It's not a magic number. No one would say that number is the touchstone, or that is, maximum employment. I would just say you ask about 3.5%. A 3.5% unemployment rate showed, gains being shared very widely across the income spectrum. In fact, going more to people at the bottom end of the spectrum. It showed labor force participation coming up above many estimates of its trend, as people who'd been out of the labor force were being pulled into a tight job market. There's a lot to like about a tight job market, particularly in a world where we didn't see inflation. So yes, we'd love to get back to that. I mean, I'd say we would like to get back, rather than to a particular number, we'd like to get back to a strong labor market where wages are moving up, where people can find work, where labor force participation is holding up nicely. That's what we really love to get back to. Now, of course, we need inflation to perform in line with our framework. But the good news is we think we can have quite low unemployment without raising troubling inflation.
Thank you. Nancy Marshall-Genzer.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, I want to follow up on the wealth gap issue. I know that you have limited tools, but are there things that you can do possibly in the area of research and maybe expand your research on racial economic gaps?
We do. We are gifted with a substantial group of researchers who really cover the waterfront, and we do a significant amount of research on racial disparities across multiple variables, including wealth, as you asked about. So we do that, and we also remember we have our Division of Consumer and Community Affairs, which is present in communities around the country, and the reserve banks all have very active community affairs groups. They're present in communities around the country. So it wasn't just the Fed Listens events. It's more just over a long period of time, we are in contact with people in those communities to understand their experience of the economy. We serve all Americans, and we know that, and we're going to use our tools to reflect that fact. So the answer is yes, we do quite a bit of research, and I suppose we could do more, but we really do a lot, and we contribute to those fields and those assessments of the state of the economy. And we do that not just because it's interesting and important, but because it's important for the economy and important for our mandate. We are assigned maximum employment. Now, what does that mean? As I mentioned earlier, it doesn't mean a particular headline unemployment number. What it means is maximum employment. So we look at that in many, many different variables, and we ask ourselves whether those variables or those labor market conditions are consistent with our assessments of what would constitute maximum employment. And that would include all of the things that we're talking about.
Thank you. Greg Roth.
Hi, Greg Roth from Market Watch. Thanks for this. I want to go back to the new forward guidance that you have, and you say that it's powerful, but you already have two dissenting voters on it, and I was wondering if there's other people who argued against it, and what do you say to the two who dissented? It looks like President Kashkari wanted a simpler forward guidance, and President Kaplan thought that the current guidance you have was fine for now. So, like, how did you argue back on those arguments? Thank you.
I wouldn't.
On the labor market,
comment
Powell just said that the unemployment rate might be 3% higher than reported because of uncounted people who showed as out of the labor force.
They're not. They're sort of on two sides of the discussion. But I would say this: I am blessed with having a committee of highly thoughtful people who bring diverse life experiences and diverse careers, and of course diverse views to our work. And I wouldn't have it any other way. I wouldn't. So I would just say right across in our discussions the last couple of days, the whole committee, everybody on the committee, is very supportive of the statement on longer run goals and monetary policy strategy and what's in there. Very, very broad support, unanimous support for that. Everyone sees the changes in the underlying economy and sees in their own way the need to address those, and including the changes we made to the employment mandate and to inflation, so that we're now in flexible average inflation targeting. Of course, there would be. We're the first major central bank to adopt this framework. There's no cookbook, and this is the first guidance under our new framework. So of course, there would be a wide range of views, and you expect that, and it's actually a healthy thing. So I welcome that discussion. I would also say this: this is all about credibility, and we understand perfectly that we have to earn credibility. This facility, this framework we have to support it with our actions. And I think today is a very good first step in doing that. It is strong, powerful guidance. It ties in very nicely with the statement of longer run goals and monetary policy strategy. We had quite a robust discussion, and there are different ideas on how to do this, but that's just the way it is when you have a diverse group of highly thoughtful and effective people. And so I'm pleased with where it came out.
Thank you. Hannah Lang.
Hi, Chair Powell. Thanks so much for my question. I wanted to ask about commercial real estate. I know you had mentioned to vary the way that Fed could support CRE borrowers, but I was just wondering if you've had any other continued discussions on that, and if there's any potential way that the Fed would step in.
Dollar stabilizing. Your USD is hugging the 1.18 level. GBP USD is around 1.2950.
As Secretary Mnuchin mentioned the other day. And I'll say just a couple of things. First, our facilities are essentially always, they have to be under the law, broad-based and not so much targeting any single sector. Also, it's important to remember that CRE, commercial real estate, benefits from several of our existing facilities. So the TALF takes commercial mortgage-backed securities and SBA commercial real estate deals, and the New York Fed purchases agency CMBS directly. In addition, I would say Main Street helps businesses pay their rent. So we're helping real estate, in a number of other ways, commercial real estate. Also, CMBS issuance has resumed. Spreads have tightened on CMBS. There are a couple of issues. One is just that commercial properties with CMBS loans often have covenants, uniformly, I think, have covenants that forbid them to take on more debt. So you have a situation, where you, without a legal change or some kind of an innovation that defies discovery so far, you have a hard time providing mass relief with regard to real estate that's in commercial mortgage-backed securities. So we're still working on it. We're still looking. I would say it may be that further support for commercial real estate will require further action from Congress.
For the last question, we'll go to Brian Chung.
Hi, Chairman Powell. So it seems like a lot of the new inflation framework is about shaping inflation expectations, but the average American that I've been watching this like confused as to why the Fed is overshooting inflation. So what's your explanation to Main Street, to average people, what the Fed is trying to do here, and what the outcome would be for those on Main Street? Thanks.
It's a very, very important question, and I actually spoke about that in my Jackson Hole remarks a couple of weeks ago. It's not intuitive to people. It is intuitive that high inflation is a bad thing. It's less intuitive that inflation can be too low. And the way I would explain it is that inflation that's too low will mean that interest rates are lower. There's an expectation of future inflation that's built into every interest rate, right? And to the extent inflation gets lower and lower and lower, interest rates get lower and lower, and then the Fed will have less room to cut rates to support the economy. And this isn't some idle, academic theory. This is what's happening all over the world. If you look at many, many large jurisdictions around the world, you are seeing that phenomenon. So we want inflation to be, we want it to be 2%, and we want it to average 2%. So if inflation averages 2%, the public will expect
Gold is
that,
struggling.
and that'll
No
be
new
what's built into
stimulus,
interest
weaker
rates, and
gold.
that's all we want. So we're not looking to have high inflation. We just want inflation to average 2%, and that means that, in a downturn these days, what happens is inflation, as has happened now, it moves down well below 2%, and that means that we've said we would like to see, and we will conduct policy so that inflation moves for some time moderately above 2%. So these won't be large overshoots, and they won't be permanent, but to help anchor inflation expectations at 2%. So yes, it's a challenging concept for a lot of people, but nonetheless, the economic importance of it is large, and those are the people we're serving, and we serve them best if we can actually achieve average 2% inflation, we believe, and that's why we changed our framework.
Thank you very much.
Thanks very much.
Last question. The Q&A is about to end, and the dollar is trading unevenly across the board. However, no major level has been broken, with the exception of Euro USD that broke below 1.18, now trading a few pips below the level. Commodity-linked currencies are also weaker, while the JPY and the GBP are the most resilient. Powell key takeaways. Economy picking up, but well below pre-pandemic levels. Rates forever low. No more stimulus for now. Fiscal authorities need to act. Monetary policy to remain highly accommodative. Fed to act as needed. No big surprises, no big market movements. The dollar is doing a bit better than pre-release, but far from bullish. That's all. That's all, guys. TKS for following us. See you next time.
Hi guys. Actually, I have been out for a moment. Yeah, you can see that the you can see that the price today doesn't change anything a lot, and all the market have some ideas about what's going on, and tomorrow I will review again what has been disclosed by Powell today, and hope that we can have some kind of information there. You can see here. Actually, for gold, you can see here I have mentioned you many times before. This area is a kind of strong resistance area for gold to break to the uptrend level at the moment. More and more, gold will. There's so many times gold has tested this strong. We have. I click here, strong. Yes, you can see it in a strong resistance zone. And if you guys have utilized and believe that this resistance zone is still effective, you guys can set a sell limit before, because I have say so many times during my some previous live stream. You can check again in the live stream in this today morning. and this area has been marked for you very clearly at the beginning. Okay, I think that today is. Do you guys have any kind of question or comments need to know? Give a commentary on, or otherwise I will stop the live stream soon. Okay. Let's see, DJ. Sorry, I forgot. Let's see. Another thing I would like to take you through the Dow Jones 30s. What has happened with the Dow Jones 30 index, and how they react with the market movement together with the news. Wow. Actually, the market doesn't change a lot, right? I think with this kind of figure like this, we can have the so we can set up the sell position this way. But for me, I need to check again very clearly the things Powell delivered during the press conference, during the press, because if we try to take out some kind of position like this, we will be very vulnerable for getting into some bad trades, because you don't know actually the rationale behind the movement of the market, because you don't check really clearly the movement of the market, and you will be choose the wrong side. Actually, you should choose the buy sell position. You choose wrongly to the sell position, and it will be very very hard for you to get the profit. Oh, I think that you can try to get sell position here. If after that you see a kind of, I call it bearish pin bar, and for bearish pin bar, it's very Forex Bunda is very it's very in favor for you to do the sell position. Yeah. Okay. At the moment, I would like to take you to some kind of I would like to get you to some kind of fixed key takeaway from the bull section here. Economy picking up. Uh, Scale economy picking up, but below the pre-pandemic level. It means that we have seen some kind of recovering of the economy of the U.S. economy, but it's still lagging behind much before the level of the level of the U.S. economy before the pandemic happened. I think it's very clear because it has already been 6 months after the pandemic happened in course on the March of 2020, and many economic projections see that. The impact of the coronavirus must be gone by 5 or 3 years in the next 5 or 3 years, and I think that the coronavirus has not been currently fully stopped at the moment, and the Powell says something like this. It doesn't kind of new information with the market. The rates forever low. That commitment is very has been repeated by the Federal Reserve many times, and it means that it's a full commitment by the Federal Reserve for the market, for the economy to have the economy recover again. So that message has been delivered by by Powell from other meeting, especially from the latest Federal Reserve rate decision. No more stimulus for now. Oh my God, this thing is more important because that's what the market is waiting for. Actually, I think that there is some kind of stimulus is waiting for the policy from the Democrat approval. But yeah, if things happen like this, I would like to take a celebration. Fiscal authority needs to act. Remain highly accommodating. Need to act. Yeah, highly accommodating. Yeah, no big surprise, no big market movement. The dollar, yeah. The Mr. Valeria agree with me that no big surprise. No more any information from the Federal Reserve. That's why the market move not exactly in line with my expectation. Actually, I personally I think that the market is moving more. And you can see that because that is no big surprise, and the market have been predicting something like this before. That's why even for Dow Jones and even for gold, it's still moving inside the more inside the price area, the same from the beginning, from the 2 day. From the whole day beginning, and hits not break out from the price hit here from the price trend from the 1950 to the 1972. The 15 price range has been still be respected, and we will see what is some other information tomorrow. We will release, for example, the jobless and continuous claim. Also, some information about the Bank of England interest rate decision, and let's see some other information for the Friday. I think the Friday there much not much information, not much economic data released in the next Friday. But I think that the key important day is the tomorrow, and let's see what the market will react. I think that for today it can be ended now. Not much movement. You can see that. I still call this is the kind of retest about the triangle has been broken out in the tomorrow in the Monday morning. At the moment, I don't like to take the sell position because I have this this candle, and this candle has been proof that this area is already very strong for the it is strong, and if you take the sell version at the moment, it will be very dangerous if the market hit this area and bounce back again, right? I wanted to take you so some kind of other thing view, other bigger view from gold. Okay, you guys can see that. Wait a moment. Actually the message I want to convey to you is that you must have an eye watching out for some fundamental element, because fundamental elements are the most important factor to drive the market going. If you say that, all I want to mention, all I want to focus is technical analysis. I don't want to keep track for any fundamental analysis. I don't wanna spend much time, because I actually I don't understand the fundamental analysis. But hey guys, if you wanna make money out of the market, if you wanna still stay on the track and improve your trading to be a professional trader, I personally encourage you to spend time learning more about the fundamental analysis. Seek for more consultation from professional trader, some experienced trader here living for staying with the market for about 3 or 5 years. And if you ask them about are you believing in of the importance of the fundamental analysis? I think that the majority of them, about 60%, will tell you that you should spend time learning about that. And here, you see, for the goal, I think that by the Elliott movement, you had A, B, C, D, and here's it's in the H4 time frame. We are in the kind of triangle like this, and more and more things happen. Will affirm me for the drop down, for the breaking to for gold to go test again the level of up here of 1900. And if they still maintain it at this area, okay, there will be more sideways in the huge wide range of the goal, and actually if there are some unfavorable information, fundamental element release at the time gold touch this area 1900. I have been I have been confident to take the sell position there, to go with the goal to test again, to break through the level of 1900, 1880. Let's see what's happening in the next few weeks. Okay, I would like to take you through some kind of information waiting for you in the tomorrow and in Friday. Wait a moment. I would like to bring you more information, man, because you stay with me at this until the last minute. Not many not many trader on the market like to talk about this, but for me, I want to introduce again my approach is the collaboration of both technical analysis and fundamental analysis, and it's my core trading edge to survive in this market. You can see tomorrow full of event. We have been through the Fed press conference. Next, we have some kind of information of foreign bond investment of net cash flow capital. These element is not. I think that is not affecting a lot for the market movement. Some Australia information element German, it will affect a lot for the pair of AUD USD. The key thing tomorrow is the Bank of Japan interest rate decision and Bank of England interest rate decision for the Asia section and the EU section consecutive correspondingly. Yeah, and we also must be watching out for the core inflation rate. And you see the forecast here, the core inflation rate is not high. That means the Euro US dollar has more supporting element to go up again. And you must to take advantage of this next movement of Euro US dollar. Because after the last bit, the last week, she don't care a lot for the exchange rate of the Euro US dollar between euros and US dollar. She focused more about the economic healing, about the recovering of the EU economic, and she said the same voice with Fed, ECB, and the financial institution authority will try to do on the best they can do to support for the healing, for the reopening, for the healing, for the recovering of the EU economic area. Also, yeah, you can see that there are more things coming along with the BOE. I think that talking about the UK, we are talking about something bullshit of the Brexit. I don't know why. I don't know why they are stuck in that nation living with the EU. But actually, if you follow with the Brexit, there are not much time for them to discuss and agree, because the October 15 is the last deadline for them set by the EU. And if they don't give out some kind of best possible option at that time, there will be more fluctuation for the market. Yeah, and tomorrow for the US section, we have in the next about 12 hours, you can see that you can see some kind of information drop the clan housing start, and these information will affect gold movement a lot. And if you finish the Thursday, you look for the Friday, the September 18. There's not much information released then, and the market will be rather silent in the next movement. Okay, guys, I have take you to some kind of information waiting for you at the moment. Goals is about this area, and yeah, and if I see any sign that gold will what through this area again, have not beautifully getting out and break out from this area, I will go with the sell position again to test that strong support zone I have brought out here. At the moment, gold has been stuck in this area between the strong support zone and strong resistance zone, and you can take the sell position during this zone to take advantage of the market movement and take the profit from them. Okay, I think that the live stream is long enough, and I thanks you guys for joining the live stream, trading with us. If you guys have any kind of question, just leave your comment there, and I will go check again and answering each question. Furthermore, if you like to hear more information trading with me and get some immediate comment from me after the market movement, without a live stream, try to check my Telegram down there and join Telegram. There will be more information relief in my Telegram channel, and it will be more fun to work with me. I think that we can do many great things together, like my slogan I said. Okay. Thank you again for your sitting with the live stream. To be introduced again, I am Elio. At the moment, I am full-time trader. I also try to challenge myself as a streamer for TradingView, and thank you TradingView Vietnam for for bringing me an opportunity to get connected with you guys here by doing the live stream, and hope you guys enjoy the live stream and stay tuned for next live stream coming up. Bye bye. Have a good day. Enjoy your day from Elio live stream.